This PowerPoint provides an overview of the use of ratios to conduct a financial condition analysis or financial analysis of a state or local government. Our focus here will be on the analysis of the governmental activities and the governmental funds rather than on the enterprises. The enterprises themselves should, of course, be subject to analysis, but the analysis of the enterprise funds is more similar to the not-for-profit organization analysis we conducted last week. And as we look at the analysis for the governmental funds and the governmental activities, we'll be emphasizing the unique features of the analysis of the government. Now, these next two slides are the same as the slides we saw last week when we looked at not-for-profit organizations. So just a reminder, for governments as for not-for-profits, ratio analysis really provides the foundation of financial statement analysis, and it is a useful tool for judging the financial condition of a government. But just as we saw last week, there are some cautions that I would remind you of when conducting ratio analysis, and we have to use our judgment in interpreting the results, and always make sure, of course, that when we compare an organization to its peers, we're comparing it to similar types of organizations. And just as we saw when we looked at not-for-profit organizations, ratios for governments can be categorized as common size ratios, liquidity ratios, solvency and debt ratios, profitability ratios, and non-financial ratios. And we'll be looking at typical ratios for governments in each of these categories. But there are two very important differences between the financial analysis, ratio analysis for governments, and the ratio analysis for not-for-profit organizations. First, we need to drill down and conduct our analysis at the fund level, particularly at looking at the general fund. If we look at the statement of net assets or statement of net position for the governmental activities, it may show an organization with a lot of cash, a lot of current assets, a lot of assets in general, and a lot of net assets, and give the appearance that the government is in strong financial condition. But as we noted when we looked at the case of Vallejo earlier, many of these assets may be restricted and may not be available to meet the day-to-day needs of government. Therefore, we need to look at the general fund, since it includes the unrestricted cash and current assets of the government, and that can give us a better judge of the available liquidity of a government for meeting its day-to-day needs. Second, the ratios we look at for governments are different than the ratios we look at for not-for-profits. We'll see this most particularly when we look at the debt ratios. First, some common size ratios. The first two of these, sales taxes as a percent of total general fund revenues and intergovernmental aid as a percent of total general fund revenues, are common size ratios that come from the income statement. They can, in some situations, be an indicator of a higher level of risk compared to other governments. For example, sales taxes are generally more volatile than property taxes. So if a government gets more of its revenue from sales taxes as a percent of total general fund revenues than its peer governments, that is, if it's more reliant on sales taxes, it may be at risk due to economic fluctuations in the future. Similarly, if a government is overly dependent on intergovernmental aid, this would be a case of a state, a city or county receiving a lot of aid from a state, for instance. And if we think that intergovernmental aid is at risk, perhaps because the state might need to cut aid as part of dealing with its own financial problems, then we might make a judgment that a local government that has a higher than normal dependence on intergovernmental aid may be at risk in the future to potential aid cuts by the state. The next three ratios, total general fund balance, unassigned fund balance, and general fund cash as a percent of general fund revenues, are also common size ratios derived from the income statement. But we'll discuss these with liquidity measures on the next slide, since in general, these are used to measure general fund liquidity. Typical liquidity ratios. Well, the first three are the three common size ratios that I just mentioned. Total general fund balance as a percent of general fund revenues, unassigned general fund revenues as a percent of general fund revenues, or if we're looking at an older financial statement with the old general fund classifications, we would look at unreserved, undesignated fund balance as a percent of general fund revenues, and general fund cash and investments as a percent of general fund revenues. As I indicated, to do our liquidity analysis, it's particularly important to look at the general fund. And these are three very common ratios used to measure general fund liquidity. We could theoretically also calculate a quick ratio or a current ratio for the general fund, but generally it's not done this way. Instead, these first three ratios are the more typical ones that are used. And in general, even in the analysis of for-profit corporations, not-for-profit organizations, generally a liquidity ratio that measures available liquidity in comparison to income or revenues is a better ratio than a quick ratio or current ratio, which is based solely on the balance sheet. So we rely primarily on these first three ratios to look at general fund liquidity. An analyst may also look at the liquidity of the governmental activities. And as I said, the focus should be on the general fund, but it can be useful to see what the overall liquidity of the government appears. And in this case, common ratios to use would be the quick ratio, the current ratio, net cash as a percent of operating revenues, or net current assets as a percent of operating revenues, all for the governmental activities. Note that the underlying terms here are defined on the next tab. So what is the definition of these underlying terms? For general fund revenues, typically when we divide something by general fund revenues, analysts will include within revenues the general fund revenues as reported on the income statement, plus transfers in, plus other sources if those other sources are recurring in nature. Typically, the other sources, other than the transfers in, are not recurring in nature, so they wouldn't be included. So generally, you'll see that general fund revenues is equal to revenues as reported plus the transfers in amount. And then operating revenues for the government activities would include charges for services plus operating grants and contributions plus general revenues. And those all come from the statement of activities for the governmental activities. Solvency or debt ratios. This is one area where the ratios for governments are quite different from what we would see in the analysis ratios used for not-for-profit organizations or for a for-profit corporation or even for a governmental enterprise. You remember for not-for-profit organizations, we evaluated debt levels by comparing debt to other elements on the balance sheet, such as total assets or net assets. This is not appropriate for governments. Governments don't use the assets on their balance sheet to pay off their debt. They don't generate revenues using those assets, and they don't sell off those assets to pay debt. And as we saw when we discussed Vallejo and other cities early in the term, the valuation of the fixed assets on the balance sheet for the governmental activities is generally not reliable financially, in that it does not really capture the financial value of those assets. So to use that in a ratio could be misleading. So what we want to do for governments is compare its debt levels to the size of the external economy that it can draw upon through the form of taxation to pay off its debt. So for government, we would typically compare its debt levels to its population, its full value, and I'll define these terms in a second, and the personal income of its residents. So direct net debt per capita, direct net debt as a percent of full value, direct net debt as a percent of personal income. Or we might also, to get a broader picture of the total burden on the tax base, we would calculate overall net debt per capita, overall net debt as a percent of full value, overall net debt as a percent of personal income. I'll make a distinction. I'll define direct net debt and overall net debt in a second. We might also evaluate what is the debt burden associated with a pension liability with a measure such as pension unfunded actuarially accrued liability as a percent of full value, remembering that the UAAL is also another long-term liability that the government has to pay off over time. Some term definitions. Direct net debt is the government's own long-term debt less amounts that are paid from enterprise operating revenues. So in most cases, this would be all the long-term debt that's shown under the governmental activities, and we would not count the long-term debt that's shown under the business type activities. Overall net debt is the government's own direct net debt plus the direct net debt of the overlapping governments which share the property tax base. So if you're looking at the debt levels on a city's tax base, you would also want to factor in the direct net debt of the county and the school district, which share the same property tax base. Full value is the total fair market value of the taxable property in the government's boundaries. It may be slightly different from the reported assessed value, because in some cases assessed value is measured differently than the total fair market value. And personal income is the total income of all of the residents of the governments within the government's jurisdiction, and that statistic is reported by entities like the Bureau of Economic Analysis and the Census Bureau. Profitability ratios are less important for governments. We're not concerned that they're making a profit, although over the long term, their revenues do have to match their expenditures, and they can't have a consistent operating deficit because that will result in drawing down available balances and could lead to liquidity problems. So one simple and direct way to measure profitability would be the change in general fund balance as a percent of general fund revenues. So again, this would be a common size type ratio, but an easy way to make comparison among governments. We definitely want to look at this over multiple years, because a deficit in one particular year is not a problem, but a persistent deficit year after year could be a sign of problems. And as always, we would supplement our ratio analysis, our financial ratio analysis, with some non-financial ratios. And three very common ones used for governments, which give some indication of its ability to pay its debt, are full value per capita, meaning what's the size of the property tax base compared to the population, per capita income, and 10 largest taxpayers as a percent of total assessed value. This last indication gives a measure of risk, where property taxes are strongly concentrated in a few taxpayers, and those taxpayers could leave or shut down or just fail to pay their taxes. That would be a risk our government would face. Please make sure you pay attention to the general principles outlined in this PowerPoint, because you will need to apply them in your project for the course.